Good morning. Welcome to Trading Hour. I am Reema Tendulkar with Mia Sumera Abdi and Pavitra Pari. Good morning, girls. The grind down for our markets continue. No panic, but we've been quietly drifting lower and lower. If you pull up a one-week chart, you would see the markets today are down for the third or fourth consecutive day. The high last week was 17,428. So from that level, we've slipped about 300 points, but again, not given up too much. The Nifty 17,000 level is still holding. The 200-day moving average is holding. So in that sense, it's just a little quiet, but we are just grinding lower and lower over the last couple of days. Keep your eye out on a lot of big events that are lined up globally. We've been saying that how back here in India, the focus is going to be on the IT stocks and the earnings. But globally, the Fed minutes come out on Wednesday. The US CPI is out on Thursday, and on Friday, 4 large banks, US banks, JP Morgan, Wells Fargo, Citi, Morgan Stanley, report their numbers as the US earnings gets kick-started on Friday. So there is going to be a lot of focus on global markets, and this week we've got a couple of Fed members also speaking. In terms of IT, despite good numbers coming through from TCS surpassing expectations, TCS stock price has slipped. In fact, that's dragging the Nifty IT also lower. That's TCS view, now down about 1.75%. But it had run up in anticipation of perhaps a beat. So if you pull up a one-week chart, you would see that from the 30th of September closing, the stock is still higher. So there was that run-up prior to the earnings, and some of the froth is now being taken away. While the Q2 numbers were ahead of street expectations, perhaps what the street is reading is that the margin beat has only come in on account of currency. If you strip that out, the margin expansion is just about 40 basis points. And who knows how winter is going to play out in Europe. That was a line that even the TCS management said multiple times. We have to wait and watch to see how winter plays out in Europe. So even though it's not that there are any red flags, no sloppiness in the TCS execution, but I think the street is still a bit watchful.
Yeah, I mean, I guess that's why the management also didn't want to give any of that kind of guidance, right, on demand or what that outlook could look like. But that's what's happening with the IT space. For our own markets, if you look at it in the broader context of what's going on in the Asian markets, let's pull a few of those up and you'll see the kind of cuts coming in. So Taiwan is down 4% right now. You have Nikkei, Kospi, all seeing cuts of between 2.2 to 2.7%. So that's the kind of Asian market setup that we are in. For our own markets, Reema has mentioned the IT space. So let me look at real estate because that one has seen some sharp cuts. It is the top sectoral loser with a cut of 1.7%. And some of the names will come up for you. We do have Q2 updates from Sobha, which look a little bit weak. And on the back of that, you have all of these stocks which are trading with cuts. In fact, if you take a look at what's happened with some of these real estate stocks in the past 1 month, pull a few of those up and you will see the kind of cuts. So Godrej Properties is down 17% in 1 month. Brigade is down 13, DLF 12. Just a few of the names, but pretty much across the board, you've seen selling over there. Pharma is another space where you're seeing sharp cuts come through. What's holding up? You have some of the financials. So the Bajaj twins are holding up in trade. And some of the FMCG stocks, which had been under pressure for the past few days, the likes of Britannia. So those ones are managing to hold in the green as well. But Sumera, all in all, this is a down day, but not too bad considering it's just a 0.5% of a cut.
All right, morning, ladies. So let's get started and tell you all that we have lined up for you today. It's a down day of trade following a weak global handover. Financials, realty, consumer stocks are the ones leading the decline, while IT bucks the trend. We'll be joined by Sunil Subramanyam of Sundaram Mutual Fund to talk about equities, the mutual fund flows, and a lot more.
And IT is on our radar today. TCS reports a good quarter with a beat on revenue as well as the margin front. We discuss the performance and highlights of the management commentary and also what to expect from Wipro and HCL Tech with Ravi Menon of the Macquarie Group.
A whole host of stocks are buzzing on the back of news. We'll get you all the details on India Cements, Panacea Biotech and Sobha a little bit later on the show.
And in some important opinion, JP Morgan CEO Jamie Dimon warns that the US economy could enter a recession in 6 to 9 months' time due to runaway inflation, big interest rate hikes, and the Russian invasion of Ukraine. Later on the show, we get you excerpts from that exclusive conversation with CNBC. So all of this and lots more coming up for you over the next 60 minutes.
But first up, let's talk TCS. A quick run-through of the numbers before we invite Ravi Menon of Macquarie on the show. Q2 ahead of street expectations on both revenues as well as margin. The management commentary also fairly upbeat. As of now, no red flags in the demand environment. The deal pipeline has remained intact. So although the macros may be weakening and the clients may be cautious, it's not impacted their business. They reiterated that Q4 FY23 margins will hit 25%, so about 100 basis points improvement is what they anticipate over the next two quarters. Attrition has peaked out, and this deal win guidance of a quarterly win of $7 to $9 billion is something that will sustain over the medium term. But what could be the weak spots in the numbers? Well, one, the margin increase or the margin beat was courtesy the currency. Stripped of that, the margin increase was just about 40 basis points. Growth has moderated already in insurance and discretionary retail, and the management says that in a downside scenario, they will be watchful of manufacturing. So what they basically said is that, in the global financial crisis, the hit came through on the financial sector. In COVID, the hit came through in the hospitality segment. If in the current situation things have to go south, the macros will deteriorate, then the impact will come through on manufacturing. Also, decision-making, especially longer-term decision-making in Europe, has seen some amount of delays, and hiring is standing at a 9-quarter low, which some people on the street are reading it as an indicator of demand slowing down, and attrition is still at uncomfortably high levels. It's peaked out, but it's still at 21.5% over the last 12 months. To discuss all this and more, the outlook for TCS, Infosys, where there is that buyback announcement, and the rest of the sector, we're joined by Ravi Menon of Macquarie. Ravi, thanks for joining in. What, according to you, explains the sell-off post the numbers?
I think, remember what you said, people are worried about the net hiring, that being weak, and they think that is an indication of poor demand. I don't think that. We think that, they had built up a big buffer bench. If you compare pre-COVID to now, they've added nearly 38% to the headcount, while revenue has been up only about 23%. I'm talking about 3Q of FY20 to 2Q of FY23. So that means that there is a lot of headroom in utilization. Yes, attrition had improved over the, if you think about it, quarter on quarter, it's flat now. So we think from here it starts trending down, and that gives you more headroom in utilization. So I think that's where management is confident to start taking up utilization. And I don't think of net hiring as an indication of near-term growth. It's more about what sort of buffer do you have, and and TCS does extremely long-term planning for how it hires. So I don't think of that as an indication of near-term demand.
All right. Hi, Ravi. Good morning, and thanks for joining us. This is Pavitra. What are your thoughts on the margin that was reported? I mean, it was 24%, but we did have that entire currency impact sort of play out. They are saying that they're confident of getting to 25% by Q4 as well. How do you look at the margin picture now?
So yes, you are right. The currency does play a role in this, and and that's expected, right? I mean, that's part of how the model is based on. So we have some headroom in utilization as well. I think that you will at least have another 200-300 basis point headroom in utilization, and that will flow down straight to the margins, which gets them back to the 26-28% band, which they're comfortable with operating. So I think that is a matter of time. As attrition starts coming down, I think you would naturally see margins start moving up.
Okay. What have you made of the commentary that manufacturing could get hurt if things go south? And if that's the case, which would be the stocks, according to you, the companies which have the highest exposure to manufacturing?
I think it's not even manufacturing overall, right? And we are looking at manufacturing in Europe specifically. And I think that even that would probably be just for, over the winter, which is 3-5 months that we're talking about. And that is worst case. I think Europe has its gas reservoirs more than 80%. The government's already stepped in to support, with gas subsidies. So the price is subsidized. We are just talking about very extreme scenarios here. If it does happen, then we are looking at, so overall Europe is about 30% of revenue, right? So even if that is 10% down, you're looking at a 3% impact on it.
And any particular companies, Ravi, sorry to interrupt, which have a high exposure to US manufacturing? Europe manufacturing?
I don't think that we have that level of detail available.
Okay.
But it's but I would think that probably we know that Infosys has a large deal with Daimler, so perhaps that they might be a little bit more susceptible. But I would think of the deal that they have as something that cannot be changed, right? You have a long-term transformation. how do you just pull the plug on something like that? And these are, regular keep the lights on kind of work. You can't really cut back on that.
Okay. And what about insurance? Which are the companies with the highest exposure to insurance? Because that's a segment, PNC Insurance, which TCS called out, where they are a bit cautious.
TCS is a little bit higher on insurance, especially because they've got the insurance BPAS as well. But that is primarily on the life and annuity side. So I think, again, it's not really something that I would worry about too much. And what I called out is just home starts and things like that, which are slightly slow at the moment, which is part of a slow economy. And I think that's a really small part of the portfolio overall, because you have travel, transportation, retail, which are bigger components, and those are doing pretty well even now.
Ravi, since we have you with us, we also have the rest of the IT pack, which is due to declare results, in this week itself. What do you think of? There's been so much news flow about them delaying the hiring process. Some from Wipro, some from the other companies as well. What do you think of this, and what are the kind of expectations you have for the likes of Wipro, Infosys, and HCL Tech?
So we are looking at pretty healthy growth from all the firms, and we are looking at margin improvement as well, ranging from 40 to 60, 70 basis points for most of these. And we think that hiring delays, I don't really think of that as, we've also heard rumors that they're having cancellations. See, every year there are some offers that are canceled just because the candidates had, some criteria. Say, for instance, they have to have a certain CGPA or don't have any back papers. At the time when they were selected, recruited, that might have been true. And by the time they have to join, they may not actually fulfill that criteria. So some offers are canceled anyway because of factors like that. Are there any additional cancellations this year? So far, what I've heard is no. And so it's difficult to actually say because we wouldn't really know, at an individual level how that is played out, right? But yeah, I wouldn't really be worried too much because we are not seeing any signs of a clear slowdown in demand. And we are looking at this as a multi-year digital transformation journey, and we are still in pretty early phases of that. So I don't think that companies will be very oriented to the short term and cut back on hiring.
Ravi, investors are still adopting a bit of a wait and watch approach when it comes to buying IT stocks because you don't know how FY24 is going to shape up. The situation on the macro front is very fluid. Budgets for next year are yet to be set. In that context, what are the kind of conversations that you have with investors? Are they willing to buy IT stocks at the current juncture?
Yeah, I think that is the problem. We don't know what the unknown unknowns, right? That's actually the problem. Difficult to actually factor that in. But if you think about it this way, where look at the incremental revenue for TCS, for instance, that's implied by consensus. If you adjust for cross currency, you're talking about a step down from about $3.5 billion of addition this year to about $2.2 billion of revenue next year. I think that is a big step down, around 30%. We've actually, for context, what we saw during the GFC was about a 50% drop in incremental revenue. So I think a drop like this in pipeline, just when it's only in Europe and it's not, if the US has a synchronized slowdown across all sectors, then we are actually in a different situation. But I don't think that the US is in that situation yet, right? We are actually talking about probably some sectors still doing really well. You have energy doing well, travel, hospitality still picking up. So even retail, which is undergoing trouble, there are retailers who are actually a little behind the curve and are talking about investing. Levi's, for example, though they gave a profit warning, they said that they are investing in a direct-to-consumer business. They want to strengthen their online channel. So these are the kind of investments that will still continue.
One final question, Ravi, on Infi buyback. The last two buybacks were about 9,200, 8,200, 8,300. Do you think this time the buyback amount could be a lot higher or a little higher than what we've seen in the past two instances, only because the company has to meet its stated capital allocation policy of returning 85% of its free cash flow and is currently short of that? So do you think the number could be more, maybe say 10,000, 12,000 this time, crores?
It is possible. I think they can even do $1.5 billion. They've got more than $4 billion, cash balance. So I think even $1.5 billion would be fairly comfortable for them if they choose to do it. Historically, I think they tried to look at about, 2% or so of share count reduction. So that's probably what we should factor.
All right. Ravi, would you like to take us through your preference in the IT pack? If you could just lay those out for us.
Yeah, our top pick remains HCL Tech, followed by TCS, then Infosys, and then followed by Wipro and last again. But we are overweight on all five because we think that the sector actually deserves a re-rating now. Because we think the consensus is excessively bearish on both revenue and margin.
All right, got that. Thank you so much, Ravi, for stopping by and speaking to us about TCS as well as the rest of the IT pack. It is going to be all about IT this week as the rest of the earnings will also flow in. But with that, let's listen into what the TCS management had to say when we spoke to them earlier this morning.
This time around, if the weakness starts, it's likely to come in from the manufacturing side. As energy, supply chain disruptions start, so we need to be wary of that. Within that spectrum, we see US manufacturing doing very well. We see some amount of caution on the European manufacturing side, and that bears watching as to how that plays out. And we need to be careful about how we are positioning on that.
But it's a function of, how this next 3-4 months is going to pan out, especially from a European perspective. If there are going to be energy crisis, if there are going to be factories are going to be shut down, and so on and so on. And then the other thing that we are also hearing is that, look, there is a recession or there is a inflationary pressures. If I'm going to get some costs because of that, should I be passing all the cost to the consumers, right? Some of them feel no, they have an obligation, a societal responsibility not to pass on all the costs. So they're doing all these scenarios, right, in terms of figuring out how that should be.
Are they asking you to bear part of the cost burden since they can't pass on the entire amount? And then what does it mean in terms of price increases?
Is there a sense that billing could be a...
No such discussions have taken place. But then, our model is always to be with the client, closer to them, react to situations, be with them in good times and bad times. Make sure that the overall long-term relationship is taken forward in the right direction. If it means that we have to give in to some of their requests, we will give in.
Currency is not in our hand. We expect it and we build it into our model, but we'll take it as it comes. Even if it goes on a appreciating trajectory, we'll have to build it into our margin. Okay. And our 25 intent is irrespective of where rupee goes.
I think our US attrition means obviously has been more than what it has been, but the differentiation of what it has been versus what it is now is less than what we see in other geographies. So I don't see that as much of a challenge. From a wage standpoint, yes, there is a slight increase in wage in US, but I think that is something which we manage through a proper mix. 35 plus 12, 47. So, that's the plan right now. The 12 is also in the pipeline, So we'll decide at the end of Q3 and beginning of Q4 if we need to do more.
Index is actually pretty much in line with the frontliners this morning, so it's around 0.4% lower. And the Nifty Bank has also picked up just a little bit. It's around 0.3% in the red. But let's do one thing. We'll talk about the mutual fund data for the month of September, which came across yesterday. Now, September saw over 14,000 crores of equity inflows, but this also has a large chunk. So over a third of this amount is from new fund offers. Around 5,800 crores of this amount is from the NFOs alone. Now, if you take a look at the debt funds, the outflows continue here. So the figure is at over 65,000 crores. And of course, this is led by the liquid funds, which saw over 60,000 crores of outflows. Now, an interesting trend that we saw is that balanced advantage funds, which, for several months have been a very popular category. They have seen an inflow this time of around 524 crores. But if you take out the NFOs from this, it's actually an outflow this time. So that's an interesting trend that we picked up. And we'll track how this moves, in the coming months as well. And finally, on the SIPs, we have seen a good figure with the contribution at almost 13,000 crores. So to discuss the data that came through for the mutual funds for the month of September, Sunil Subramanyam, Managing Director and CEO of Sundaram Mutual Fund, joins us now. Sunil, good morning and thanks for joining us. This is Pavitra. First on the total inflows itself, yes, it's 14,000 crores, which, doesn't look bad, but a big chunk of this is from the NFOs. So if you take that out, the figure, of course, is not quite as healthy as that. Do you think that this is some amount of sort of worry or uncertainty creeping into the market now?
Not really. If you segregate this data a little bit more, you will see that month-on-month redemptions have been flat. So which means that people's concerns about redeeming their existing funds is not there. So that's one strong signal of confidence which you'll see in the underlying data. The second, as you mentioned, is the sharp uptick in the SIP on a month-on-month book by almost, I think, 500, 600 crores. It was about 12,400 odd last month, and it's about 13,000 crores. That again indicates. The third is, if you look at the composition, now you mentioned about 6,000 crores from NFOs, but the point of the matter is, if the redemptions are flat, it means there's new money coming into the industry from either bank deposits or other financial asset classes. That's again a healthy trend of inflows. And finally, if you look at the composition of the breakup of the funds this time, when you take away the passives, I think the ETFs got about 10,000 odd crores, but you see mid-cap and small-cap funds have been the ones grabbing apart, and then sectoral thematic, which again, I think there were business cycle funds and the like which were launched. So the point is, I think that the Indian investor is getting a little more mature. He's figuring out that in a world which is in recession, India is still doing well. So focus on the India-specific areas, which is mid-cap, small-cap, business cycles, I think all the lot. The other aspect also, which is a pointer to the growing confidence of the retail investor in the Indian economy and the markets, is the shift away from balance advantage. Now, balance advantage is typical play safe. When there is volatility, when you're worried, is when you tend to increase allocation, because then you're trusting the fund manager to shift within debt and equity. But the fact that if you take away the NFO in that it's come to negative, it means that there is a reallocation of money away from balance advantage into active equity, which is again a growing sign of confidence of the investor. So there are lots of pointers here which indicates a more maturing and a more confident retail investor in the country. And that's a good sign in the times to come.
But Sunil, the whole premise of selling the balanced advantage fund was downside protection in a market like this. And, wouldn't it then be appropriate to increase allocation now? But that aside, the equity allocation is not increasing at the pace to mutual funds as one would have liked or anticipated. Is some of this money also going into, PMS?
Definitely at the super HNI level, there is a lot of money going into PMS and alternates. And if those numbers are not reported by AMFI, but yes, what you say is very true. The HNI is looking at it, because the reason, Sumera, the answer to that is that the fact that balance advantage, and you brought in balance advantage again, right? So the balance advantage funds are actually play safe, is when you don't have conviction. And in a time when the markets are correcting, it's volatile, and international news flows are so much of a headwind, you still find the investor choosing active, which is either you say PMS and AIF, or you say mid-cap and small-cap, which are the higher risk parts of the market, right? So this is what is giving me a confidence that the investor is making the right choices in times of volatility. This whole SIP, rupee cost averaging, why do we keep talking? It is because you got to buy when the market's correct, which is what rupee cost averaging does. If the lump sum is itself acting in that way, I think it's a good sign of maturity. I mean, I think coming months will also bear out whether this is true. But in a time for the market is volatile, to see equity inflows go up by any amount, I think it's a strong vote of confidence.
Okay, strong vote of confidence. Sunil, I'm going to throw in a few questions on the market as well, because, you were mentioning the entire setup, and we have been talking about what the global markets are looking like. Of course, India is outperforming still in that context quite significantly. But, usually you don't see this kind of decoupling last forever. I mean, and you do see a catch-up pretty soon. So do you think that is sometime soon, or do you think it is still a while away and we will see the markets continue to outperform for a while?
I think our markets will continue to outperform for a while. I'll tell you why. Because while interest rates are being hiked and the market is nervous about that, what does that interest rate hike actually do is what I think we need to focus on. So the first thing the interest rate hike does is makes US debt attractive, right? So to the extent that there is money which is equally choosing between debt and equity, you would expect the debt allocation to go up, right? So that's one flow in the market you will see happening. Investors who have a choice between debt and equity will switch from equity to debt, and that's why the equity markets are volatile. That's number one. But second point of this is that interest rate hike is actually going to bring on a recession, right? Because it's killing demand in the US. You already saw US housing loan interest rates have gone up from 2.5% to 6%. That's the impact of the rate hike. So demand is naturally going to get killed, right? So then in that scenario of the killing of demand, then you're going to see softening commodities. So if you then say softening commodities, including oil, then you search, right? Because there's still $30 trillion of QE money of the G4 countries floating around in the world. They may remove 100 billion a month, 200 billion a month, that's 30 trillion, but look at the size of that pool. Now that money, how much of that is equity to debt? I don't think that's very shiftable. There are equity investors, an equity investor, a debt is one. Second is within that, India market is about $600 billion of FII flows. So this delta that happens, right, happens between, in a risk money, between a, let's say, a commodity exporting country which benefits in rising commodity inflation time and will lose money in commodity deflation, right? So countries which have heavy commodity exports like Brazil tend to get benefited when commodity prices rise. But now, with an interest rate hike, you can see that commodity deflation is the order of the day. And so there will be a shift of capital out from commodity exporting countries like Brazil and the like to a commodity importer. 83% of oil we import. So there is a reallocation of capital which I expect where India will be the beneficiary, number one. Number two, the commodity deflation will positively impact our economy itself. So forget about flows. The economy itself, you see, even right from FMCG to auto to fertilizer, there's so many of our sectors use oil as an imported derivative. Their input costs have been under pressure for so many months. Now the commodity things have started easing. That story, if it's going to continue, it means corporate margins are going to be healthy. India's fiscal and trade deficit pressure will be less. So to look at it that way, right, reallocation of flows will happen to that country which has a better economic future. There will be volatility in the short term because news flows tend to make people act. But bottom line, money has to find its level. Money can't remain idle. So when Brazil markets will go down because of deflation, it has to find an alternative heaven, and that's where India will show itself up. So I strongly believe that this flow of risk capital, the risk capital itself may reduce because of the recessionary forces. But whatever risk capital remains, India's allocation, I think, will tend to grow and will support our markets, and the commodity deflationary scenario will benefit our thing. Then from a domestic sector perspective, you obviously focus on the domestic oriented sectors. Why? Because the factors which will affect India as an economy are the export side. So if the world is going to a recession, you would expect exports to naturally suffer. So placing your bets on a domestic cycle where the government plus PLI plus private sector capex is strongly driving GDP growth, which is a supply-driven GDP growth, is less likely to get affected from a recession than a very heavily export-oriented economy, like many emerging countries are. So to that extent, India will be, the impact of recession will be there on India. IMF has already revised from 7.5 down to 7 to maybe 6.5. But still, 6.5 in a world tending towards zero growth is, I think, a very good outlook for us to be a magnet for foreign capital. And FDI flows are not ceasing. FDI flows continue to be strong. So I would tend to put focus on domestic-oriented sectors and say that India will still be an attractive market. And these words like coupling, decoupling, are big words. Right? I don't want to use those kind of words, but to say that if you have $30 trillion of liquidity, simply, it has to find somewhere to invest, right? It's not all going to...
All right, we take that point that you think that, even in this situation where even, though the US might head into a recession, India perhaps looks much better placed. So we take that point. Sunil, thanks a lot for joining us and taking us through your call in the market as well as the mutual fund data. It's time for a short break, but when we come back, a whole host of stocks are in focus. We're going to tell you why they're moving around on the other side.
Welcome back. As promised, let us shift our attention to some stocks which are in the news. India Cements is down almost 5% on the back of JSW Cement's acquisition of the Springway Mining for 477 crores. Nigel is standing by with the details of this story. Nigel.
Well, JSW Cement has gone ahead and bought India Cement's subsidiary, that's Springway Mining Private Limited. The key asset in this particular subsidiary is a limestone mine that they have in Madhya Pradesh. The total quantum that they mentioned is around 477 crore rupees. Motilal Oswal in their note, they mentioned that they've had a conversation with the management and they expect another 127 crore rupees, which effectively was the money that was given by India Cements to this particular subsidiary, including interest. So the total deal value, they say, is around 604 crore rupees. The impact of this is they could effectively reduce that by close to 20% because the last reported debt number was around 3,100 crores. The promoter intent as well will be read possibly. And what the street will wait for is any kind of clarity whether or not they want to sell any of their other assets. Maybe the Rajasthan asset that they have, which is around 1.5 million tons. Well, it's a step in the right direction, but brokerages, they're not very enthused. Motilal says they reiterate their sell rating, though they've increased the target price to around 180 rupees. Valuations is one factor that they cite. It's trading at close to around 15 times EV upon EBITDA, and also $82 on an EV per ton basis. They're saying there's no big capacity addition that they're talking about on the net debt to EBITDA basis as well. Things look elevated. Moving to Nuvoma, they say the move is certainly welcome, but more needs to be done on the deleveraging front. And if there are higher sales of non-core assets, then they'll be impressed. They maintain reduced with the target price at around 112 rupees from around 103 rupees earlier.
Nigel, thanks very much. Also, several pharma players are buzzing today on the back of news flow and analyst commentary. Vivek is here with all the details. Hi, Vivek.
Well, hi. The data that we are tracking is actually data that we've got from IIFL Institutional Equities. Now, this particular data is the second quarter export data trends as far as pharma players are concerned. And this data is actually being collected from various industry export databases. So some of the stocks that are in focus and that are reacting in the session today, the first on our list is Gland. What IIFL says is that, exports for this particular quarter are up almost 20% on a sequential basis. The other stock on the radar is actually Divi's. Now, Divi's, what IIFL is highlighting is that may see a greater than 20% sequential decline in this particular quarter. And what IIFL is saying is that both the base business as well as Molnupiravir, COVID-19 vaccine is actually something that has seen quite a bit of significant impact. And on the back of that, today we're actually seeing Divi's Lab fall quite significantly. Laurus Labs expect second quarter exports to go up almost 10%. Ipca Labs exports have seen to have declined almost 11% on a sequential basis. JB Pharma, some strong growth seen there, almost 30% year-on-year growth as far as export sales is concerned. Other than this, another company that we are tracking today is Panacea Biotech, a very large order win that the company has received for a particular vaccine, a pentavalent vaccine. Now, this particular order is for $127 million, approximately a little over 1,000 crore rupees. And the contract the company has got is from UNICEF as well as the Pan American Health Organization. So this particular stock was locked at the upper side. It cooled off a little bit in the trading session today.
Okay, thank you very much for that. As we slip into a very short break, here is some important news for all our investors. You can now track the US market action real time on Money Control. All you need to do is log on to the Money Control website or app and stay informed. Welcome back. Let's tell you the next stock, which is on our radar today, and that is DLF. The company is witnessing a strong pickup in sales and leasing of properties across cities. Tim C joins us for more details. Tim C, what have you picked up?
Well, company sources are telling CNBC TV18 that when it comes to the office space, the leasing exercise, well, DLF is seeing a rise in return to work, more inquiries, faster leasing. 85 to 95% attendance has been seen in Cyber City in Chennai, Gurgaon, and similar trends are being witnessed in Hyderabad and Kolkata. When it comes to the recent leases, they include about 1 lakh square feet of the new downtown space in Gurgaon, and the company is looking at re-entering the Noida market after a decade with a new IT park, a data center that the company plans, and 75% of this data center is already leased. Rest is in progress. When it comes to the retail side, well, festive season has started with higher footfalls across malls. Remember, DLF has a good presence in malls as well. The retail expansion is also planned in NCR. About 3 million square feet of mall in Gurgaon is likely to come up, which is going to be the largest mall in India. Also, when it comes to Goa, they're seeing a good footfall. The company aims to double around when it comes to the retail portfolio by adding 4 million square feet. When it comes to the residential homes, they are seeing strong sales despite successive home loan rate hikes. DLF 5 Groove clocks around 1,800 crores of sales, that is sector 93 in Gurgaon, and also 600 crore rupees of sales in the new launches in Panchkula have been clocked. So overall, a lot of development when it comes to all the three sectors where DLF is present, that is retail, residential and office space. Back to you.
All right, Timsy, thanks a lot for taking us through all of the details on DLF. Positive news coming in, but it's really not the day for real estate today. It is the top sectoral loser, with a lot of these stocks, the likes of DLF, Sobha, all seeing some sharp cuts. The market, however, is picking up a little bit. It's just around a 0.3% in terms of a cut on the Nifty, and the Nifty Bank actually has even moved into the green right now. It's around 12 points in the green, led by Axis, SBI, and ICICI Bank. So let's see how we fare from here. But with that, we're going to wind down. Thanks a lot for tuning into Trading. Our halftime report is up next.